We saw an improvement in the latest CPI number at 3%, but the PCE number is what Fed is concerned with, as it is still lingering around its high point, and the last 20 years, averagely, it was staying at about 2%, but today it seems like it is pointing up again. Now, what we're seeing here is that over the last 40 years of interest rate, if it remained elevated, how would that impact the market? And how are the banks doing today? Out of this 4,000 banks in the United States, it seems like JP Morgan from this top 7 banks is the only bank that has climbed up from the March banking crisis. The rest are still well below their March level. How about the other thousands of banks? The banking crisis in March was triggered by the rising interest rate, and this trend suggests more upside to come. And today we're going to discuss about 2 key points. Number 1, why the interest rate should continue to trend higher. And number 2, what is the relationship between a higher interest rate and the banking crisis. But before we discuss about this topic, please do take some time to read into the disclaimer down here. Now let's get started on the last 40 years of interest rate, and I'm going to convert to a yearly chart. And that's what we're seeing over the last 40 years. And we're going to study into it technically. I'm going to draw a trend line and I'm going to make adjustment. And if you've been following my previous tutorials or videos, how I draw a downtrend line is that first we have to find at least 3 significant peaks. Then number 2 is that we're going to make our best alignment like what I've just did. And we can see that the last 40 years, the interest rate in different tenure, it has been trending very nicely along this classic downtrend line. But in 2022, there's this piercing body. It convincingly, technically broke above this downtrend line. Now, this signal that likely in the near and far future, this is what I'm seeing on the interest rate. And we could see that around the world, the central bank, it seems like they're having a hard time to contain the inflation. And what we are seeing here, the rest, they are the different tenure. And like what I said earlier, you can try on the different tenure, you will give you the same result. There's the 2 years, yield, 5 years, 10 and 30 years. And these on top, they're the cash. And of course, cash are not really tradable. But if you want to hedge or trade into the interest rate or yield, you can consider the yield futures in CME. Now, let me just discuss about in a context of a rising interest rate, what will happen to the bank. Now, first, it started with the March banking crisis. And we saw 3 banks in US and 1 bank in Europe collapse because of a higher interest rate. Now, first of all, we have to understand the concept that banks pay interest rate to their depositors or saver. Now, it all started with SVB and the rest of the banks, the other 2 banks in the United States. They have to invest all this deposit money somewhere. Now, during the pandemic years, they have rolled into, it could be a mistake, it could be a mismanagement or miscalculation, that they have invested in a 10 years bond yield at about 1.79% averagely. But the problem was that they lock in for 10 years. But at that point in time, it make a lot of sense. That was before February 2022. Now, pandemic started in year 2020 to 2000. We just entered into the post-pandemic. But then was that they earn 1.79%, but they pay to their depositor 0.25% as a saving interest rate earned by their depositor. So it makes sense that they make this spread. But the problem was after February 2022, that's where Fed and the rest of the central banks start to increase the interest rate. Now, come to a point that they still have the obligation to pay interest rate, but they are still stuck with this 1.79% payment or return from the investment. When it comes to a point where the Fed fund rate is above this level, there became a problem. And today, the Fed fund rate is at 5.25%. And I hope that explained what actually happened. So the next question is, if the interest rate continue to rise, yeah, which is we study about it, technical reason, if it continue to rise, will that trigger another banking crisis? Now, as we continue to track the CPI numbers to get a sense of inflation and interest rate sentiment, do also reference to the PCE numbers as well. It covers a broader range of goods and services compared to CPI. PCE provides a more sensitive measurements of the inflation. Always enjoy studying the correlation between the markets and to uncover potential opportunities. And I hope today's sharing it will be helpful in how we invest and trade. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you have stayed through this tutorial. You have many great trading weeks ahead.